If you've ever looked up how to start investing, you've probably seen two terms pop up again and again: index funds and ETF. Everyone says they're the best way to invest, but here's the problem. Most beginners don't actually understand how they're different. They sound almost identical until you start investing and realize those small differences can make a big impact on your returns, taxes, and flexibility. So in this video, we're breaking it all down: what they are, how they work, the key differences, and which one might make more sense for you. Welcome to the Wealth Guide, where we make money and investing simple for everyone. And just a quick disclaimer, this video is for educational purposes only and not financial advice. What are index funds? Let's start with index funds. Imagine you walk into a grocery store. You could either spend hours picking individual items one by one, or you could grab a pre-packed basket that already includes all the essentials. That basket, that's an index fund. Instead of buying one company's stock like Apple or Tesla, an index fund lets you buy tiny pieces of hundreds of companies at once. Each index fund is built to track a specific market index, like the S&P 500, which includes 500 of the biggest U.S. companies. So, when you buy one share of an S&P 500 index fund, you're automatically investing in all those 500 companies in one go. If the overall market rises, your investment rises too. Now, here's what makes index funds so beginner-friendly. They're passively managed. That means there's no fund manager trying to guess which stock will win next quarter. The fund simply copies the market. Because of this, fees are extremely low, often as little as 0.02% per year. That's like paying 20 cents a year for every $1,000 you invest. However, index funds are priced only once per day after the market closes. No matter what time you buy during the day, you'll get the end-of-day price known as the NAV, the net asset value. This once-a-day pricing makes index funds great for long-term investors who don't need to trade actively. What are ETFs? Now let's talk about ETFs, or exchange-traded funds. On the surface, ETFs look very similar to index funds. They also give you exposure to a whole basket of stocks or bonds. But here's the difference. ETFs trade on stock exchanges, just like regular company shares. You can buy or sell them anytime during market hours, and their price moves up and down throughout the day. So while an index fund's price changes only once a day, an ETF's price is constantly changing based on supply and demand. This makes ETFs more flexible, ideal for investors who want the ability to buy and sell quickly or set stop loss and limit orders. Most ETFs are also passively managed, tracking indexes like the S&P 500 or NASDAQ 100. But some ETFs are actively managed, where professional managers pick stocks trying to outperform the market. These usually have higher fees, though, and studies show most don't consistently beat passive funds in the long run. ETFs have also become extremely popular because of their convenience. They combine the diversification of index funds with the flexibility of stocks. Key differences between index funds and ETFs. Let's make this super simple. First, trading. Index funds are priced only once a day, usually at the end of the trading day. ETFs, on the other hand, trade just like regular stocks. You can buy or sell them anytime during market hours, and their price changes throughout the day. Next, management style. Most index funds are passively managed, meaning they simply track a specific index. ETFs can be both passive or active. Some just follow the market, while others have managers who try to beat it. Now let's talk about fees. Both index funds and ETFs are known for being low cost, but in most cases the difference in fees between the two is pretty small. When it comes to taxes, there's a slight edge for ETFs. ETFs are usually more tax efficient because of something called in-kind redemptions, a process that helps minimize taxable events when investors buy or sell shares. So, who are they best for? Index funds are great for long-term, hands-off investors who prefer to set up automatic investments and forget about it. ETFs are better suited for investors who want flexibility, people who like having control over when they buy or sell. And finally, minimum investment. Index funds often require a starting amount, usually between $500 to $3,000. ETFs don't have that barrier. You can get started by simply buying one share. In short, index funds are like a set it and forget it meal plan, ideal for people investing automatically every month. ETFs are like ordering a la carte, more control, but you need to pay attention to timing and trading costs. Here are some pros and cons of index funds. Pros: perfect for beginners and long-term investors. Simple. No need to pick or time the market. Low fees and easy to automate with monthly contributions. Cons: you can only trade once a day, no intraday flexibility. Some have minimum investment requirements. May not be as tax efficient depending on your country. And here are some pros and cons of ETFs. Pros: can be traded throughout the day like stocks. Often more tax efficient than index funds. No minimum investment. Even a single share gets you started. Great for investors who want more flexibility. Cons: prices fluctuate throughout the day, which can tempt beginners to trade emotionally. Some ETFs have slightly higher transaction costs depending on your broker. Not all ETFs are equal. Some track very specific or risky markets. So, which one is better for you? Index fund or ETF? Here's the truth. Neither one is better. It all depends on how you invest. If you're the kind of person who prefers a simple hands-off approach, where you just set up automatic investments and let your money grow, index funds are probably the way to go. But if you want more control, maybe you like watching the markets or adjusting your portfolio more frequently, ETFs might suit you better. The key is this: both are excellent tools for building long-term wealth, as long as you focus on low fees, consistency, and staying invested. So that's the difference between index funds and ETFs, two of the most powerful and beginner-friendly ways to invest. In the next video, I'll explain how to choose the best ETF or index fund for your first investment. If this video helped clear things up, make sure to hit the like button, subscribe, and turn on notifications. Thanks for watching, and I'll see you soon.